For the first time ever, Yemi Cardoso's led central bank has held rate. After the Monetary Policy Committee meeting that held yesterday, the CBN has held the benchmark rate of 27.5%, the cash reserve ratio held at 50%, and liquidity ratio maintained at 30%. The rates were held in response to inflation data which the NBS released on Wednesday, where we saw inflation for January 2025 at 24.48%. On the show today, we are going to be exploring is our inflation problems over, and the very many effects of these held rates on the capital market and the economy as well. Welcome to Economy and Market, where we give you a comprehensive breakdown of market and economic activities. I'm your host, David Olujimi. Okay, let's picture this for a moment. A manufacturer in Ogun State is staring at these numbers: skyrocketing input cost, thinning profit margin, loan repayment schedule that feels like a chain tightening around his neck or her neck every quarter. And this is the reality for countless businesses across Nigeria, with interest rates between 32 to 36%. Manufacturers have groaned and have complained about the rising interest rates, the cost of borrowing, basically the cost of capital, and essentially the cost of debt. But Yemi Cardoso has maintained a stance. I think for the manufacturers, they should be more appreciative of the fact that there was no hike in the interest rate, because in 2024 we saw 6 consecutive increases. So interest rates were held at 27.5%. Basically, inflation at 24.48%. Even though it looks like it's a relief, but it's still a lot. It's still a lot for a developing economy such as ours. A decline from December 2024, 34.46%. And now, one thing that we know is that the CBN's decision to keep rates is a double-edged sword. On one hand, it signals stability, but for manufacturers, they are navigating a storm with no shelter. Borrowing costs still remain high, loan for expansion, even routine operations. These things are slipping further out of their reach. And when businesses can't borrow, they hardly grow, or they can't even grow. And when they can't grow, they are unable to create jobs. And when jobs stall, consumers have to tighten their belts even more. It's a vicious cycle. So basically, on the show this morning, we're going to be reviewing what this means, the held rate, what it means for the Nigerian economy. However, before we go there, there's something something that is of pertinent interest to this show, is the fact that, are we out of the inflationary circle? Over the last few months, we've been seeing a rise in money supply, and if the CBN links inflationary pressures to the high rise of money supply, what does that tell us? It means that the driving force of inflation is not yet over, I think, or I'm hypothetically saying. On the show this morning, we have Samuel Uyekomi, who is a research and insight associate at Norm Baja Financial Group, reporting live from Abuja. Good morning, Mr. Samuel.
Hey, David. Thanks for having me.
Yeah, so basically, let's start. Let's go into it straight. Can I get your overall reaction to the MPC outcome? Was it any different from your projected outcome?
Yeah, so I think the decision of the CBN to hold interest rate at 27.5 pretty much aligns with market sentiment. Casually mine, I'd envisage that the CBN should be holding interest rates considering a number of factors, right? We saw the NBS releasing the rebased inflation figure earlier in the week at 24.48%. While many might see that as a relief, of course, we know that that's a statistical decline, not necessarily reflecting in terms of prices. But as of the end of last year, we envisaged that the interest rate had peaked at the current levels, and any more tightening might further put a strain on the economy and on businesses. And as rightly said when we were during your introduction, a number of businesses are already going through a lot of pressures when it comes to repayment of loans and even access to capital. Look at data last year. The number of corporates that were able to issue commercial papers or bond issuances last year declined significantly, and this is as a result of the high cost of capital in the capital market. Even the government is also bleeding high. The latest budget, you could see the portion of that particular budget that is allocated for debt servicing, a huge part of which is domestic debt. So I think it was preempted that the CBN should be holding rates at this point in time.
Okay, so let's get into the part of the show where I want to talk about inflationary pressures. So if we go by CBN's hypothesis of money supply being a major trigger for inflationary pressure, at least according to Norimbaja's report, we saw that money supply has hit an all-time high as of January 2025. If we go by that data, we go by that report. And the CBN has told us countless times that the rising money supply, cash in circulation, is a driving force for it's a major trigger for inflation. Can we say, despite the inflation dropping, can we say we are done with the inflationary circle? Can we say we are done with this phase of rising inflation?
So of course, first, let's not be deceived. Even the CBN governor mentioned it yesterday, reiterated the fact that inflation has not gone down. So we are not comparing 24.48% to 34.8% recorded in December. You would just be comparing apple for pie. So they are not the same. So that is not enough to say that inflation has declined. Of course, the expectation is also that the pace of inflation has reduced, not necessarily inflation in itself. But going back to the money supply issue, so money supply in January is currently at around 110 trillion naira. And a major part of that increase you can ascribe to that component called the net foreign assets. Following devaluation of the naira, we saw a surge in dollar-denominated assets, and that has triggered a surge in terms of our money supply. It used to be around 90 trillion at some point, but now over 110 trillion naira. And then again, the fact that despite the fact that we have a lot of currency in circulation, it's currently over 5 trillion naira. The CBN still keep pumping currencies into the economy, and this speaks to a host of many other structural issues, because over time you hear we also complain about the lack of access to cash in several areas of the economy. And then you see 90%, a huge 90% of the currency in circulation is actually outside the banking system. This also forces the CBN to keep printing money into the economy. And then you tend to ask yourself, how will currency in circulation reduce? Is there really a future, a near-time future where that particular value tends to decline? I think that's a major concern that we need to look at. But my own opinion, I think one thing that everyone, many analysts over the years have mentioned, is that the major part of inflation in Nigeria is driven by structural issues. Yes, there's a money supply thing that came from on the back of COVID-19 and a number of funds that were pushed into the economy to drive growth. But the major aspect is still the structural part. Initially, you find our inflationary basket having over 50% of that being food. And you know the number of things affecting food in Nigeria. The fact that farmers are not able to access their farmland, the fact that climate change has also impacted harvest, or the lack of logistics within the country to be able to move food from the producing areas to the consuming areas, transportation, insecurities on the road, and also many other factors, just impacting over 50% of that basket. Then the other 48% has things like imported inflation in there, has things affects impact in the petrol subsidy removal. So it just gives you an understanding of some of the major drivers of inflation. Yes, there's the money supply part, but in my opinion, it's minimal compared to the major elephant in the room, which is the structural issues that we're still battling with.
So you mentioned something very important. You've talked about structural issues affecting those that is a major driver of inflation. But you said something about 90% of cash in circulation being outside of the banking system. So it brings me to it's a circle moment. It brings me to a conversation I had with one of these POS agents. That was last week, and they told me that they've not been getting money from the banks. They've been getting money from market people, fellow traders in the market who are making sales in millions of naira. They go there to buy cash. And now it gets me wondering, do you think this now we've established the fact that that inflationary cycle, we're not yet out of it. We can't claim to be out of it. But what do you think the government can do, or what do you think the monetary authorities, that's the CBN, what can they do now to say, okay, let's drive cash back into the banking system. Let us find a way of getting cash back into the system. Is there any way out for them?
Okay, so I think it's a function of social trust. The Nigerian mindset, an average Nigerian thinks more of cash rather than digital banking or any other form of cashless banking. And it also speaks to the level of financial inclusion that we have in Nigeria. So first, there needs to be a reorientation that educates Nigerians on the benefits of moving from the cash-based transaction to cashless transaction. It baffles me where when you go into some areas and they tell you they don't take transfers, and again in their defense they tell you the infrastructure is not good enough. They might not get their funds in time, and in some cases fraudulent certain people have used that to defraud people, where they give them fake alerts and all that. So there are a number of issues around that, which is also structural in itself. I think government needs to address those bottlenecks in terms of the infrastructure. I know the banks are trying their best in recent time to be able to upgrade their systems to be able to accommodate as much transactions, but a lot more needs to be done in order to ensure that we improve the level of confidence and trust that the people would have in the system. Because when you have that system in place, when you go out there to try and enlighten the public on the benefit of using or of moving away from cashless or from cash transactions into more cashless and digital transactions, it makes more sense when you tell them that these are the benefits, and I think that's gonna work in the long run, medium to long term. But if we do not take away those factors that limit Nigerians to be able to access digital facilities, I think it becomes a problem. And if we do not tackle that, even the MPR increase that we've been having in recent time might not necessarily impact as much people as we would imagine. Because what it tells me, in fact, before now, it used to be around 93 to 94% of the cash in circulation outside the hands of the bank. What it tells me is that tightening is going to affect just about 6 to 7% of the economy, whereas the larger population, who are over 90%, don't really feel the effect because the cash is in their hands. They don't necessarily have to go to the banks.
Okay, that's the revelation. So let's come back on track. Potential impact on the fixed income side of things. NT bills are declining in, at least now we've seen yields hit 1 year low. That was at the recent NT bills issuance that happened, I think, on Tuesday. Now, NT bills, are they going to lose their allure of high returns? We've seen Nigeria being touted as a major capital import destination when you want to get high returns, considering we're in that corridor of stability, as some people put it, with our naira. Are we going to continue on the pathway of declining returns over the next couple of issuances? Do you think so?
Yeah, so very possible, and that's something that is already a trend. So if you look at the last 4 to 5 issuances, whether at the NT bills and at OMO auctions, you've seen persistent decline in those bills, especially for the 1 year bill. If you're talking about T-bills, and that's not surprising. It has been high for long, and what we start to see is that we start to see a decline, and you could also see that reflect in the secondary market also, as yields are beginning to taper down. But it doesn't change or it doesn't disincentivize investors from moving their monies or their investments into this. I don't forget T-bills, bonds, and whatnot, fixed income assets, they are risk-free. And what it means to be risk-free is that whenever you can ascertain your return, even from the beginning of your investment. Look at the OMO auction, we still had over 2.9 trillion naira in terms of subscription. So wow. However you put it, as much as this interest rate continue to taper, you still have a number of investors who are still willing to bet on them, because what are the alternatives? Stocks can be variable, can be volatile depending on how it goes. Last year we saw a significant rally in the market, the chances are you're not going to get that much rally again in the equities market. So you might have a slower pace of growth or gains in the market. And that is going to more or less deter or de-incentivize most investors who are risk averse, especially in a market like Nigeria. So yeah, I think it is still a good opportunity for investors, and you would see that play out, especially in the bonds market, where a number of investors are trying to position themselves for this yet high yielding instrument, because the chances are interest rate will continue to decline. You might never get these kinds of high yielding fixed income instrument in a very long time. So yes, it is still inviting for investors to put in their money.
Okay, thank you so much, Mr. Samuel. It's been a very insightful conversation with you. Um, thank you so much for thank you so much, Mr. Samuel Oikomi. It's been lovely having you. Okay, before we go on, before we round up the show, we want to talk about something about the CPI rebasing. So I discovered that there's not much understanding of what went on, and I'm going to also give my personal opinion on what went on with the CPI rebasing. If you look through the instruments used, if you look through the methodology developed by the NBS, the NBS developed a methodology that is okay. There was a decline. There's something called the CPI basket, and in the CPI basket we have a range of goods, services that people usually use to achieve their day-to-day life. So we have food, non-alcoholic beverages. Basically, these are the five major things that made up that really led to the recalibration of the basket: food and non-alcoholic beverages, housing, fuel and electricity, transportation, education services, and restaurant and accommodation. So according to the NBS, they tell us that in the previous basket use, there was food, non-alcoholic beverages contributing 51.8% to the basket. Housing, fuel and electricity contributed about 16.7% to the basket. Transportation 6.5% to the basket. Education 3.9% to the basket. Restaurant and accommodation 1.2% to the basket. Essentially, they tell us that food made up about 52% of the average Nigerian need, of the average Nigerian household need. But since the recalibration of the basket, what they tell us now is that food now makes up about 40% of an average Nigerian household need. Housing, fuel and electricity makes up 8.4% of a Nigerian household need. Transportation 10.7%, education went up to 6.2%. But most surprising of all is restaurant and accommodation, 12.9%. I've asked around, does this valuation seem fair to the average Nigerian? I don't know how many Nigerians spend 12.9% of their income on restaurants and accommodation, basically going to restaurants of all kind, whether it's the roadside one, or it's the fancy restaurant, or spending money on Airbnbs or on hotels and stuff like that. Okay, another thing we should also consider is that the accommodation here is very separate from housing. Some surveys carried out in 2024 showed that an average Nigerian spends 57% of their income on food. Now, it begs the question, why is the National Bureau of Statistics telling us that now that volume has dropped to 40%? It begs the question. Now, housing has also increased. People are spending more on rent. In Lagos, for example, there's been a lot of complaints about the amount spent on rent. And we also saw fuel prices increase. We saw electricity prices increase. How is the NBS telling us that the spending on housing, fuel and electricity has dropped to 8.4%? I think all of this begs for a little bit of consideration, and there needs to be, it's quite confusing when you look at the fact that this does not, from my own perspective, does not really tell the Nigerian story. Anyways, that's all we can take for today. Thank you so much for your time. My name is David Olujimi. I'm your host. This is Economy and Market. See you again on Wednesday next week. Have a nice weekend.